Good afternoon, everyone. Thank you for joining us today for the last webinar of the Loan Vision Industry Insight Series. My name is Jordan Pavelka. I'm the Marketing and Communications Manager here at Loan Vision, and I am joined by Henry Chavez of Spiegel Accountancy Corporation, who will be presenting on our topic today, Demystifying Financial Statement Reporting. Henry is a principal at Spiegel, where he provides assurance and business consulting services to privately held businesses in the financial services, manufacturing, and distribution, technology, and nonprofit sectors. If you've been a part of the Loan Vision family for a while, you'll have heard his name before because he has a knack for charming his way into presenting at our conference or writing thought leadership for the newsletter. All jokes aside, he is an incredibly knowledgeable CPA and is always searching for ways to better help his clients. Henry, how are you doing today?
I'm doing fine, Jordan. Thank you for that beautiful, choreographed and orchestrated introduction. It did it just right. Thank you so much.
Oh, only the best for you. Only the best for you.
I want to say, first of all, thank you to yourself, Carl, and Martin for allowing us to present. It's always an honor to present for your company, and it's a pleasure working with you. Thank you for allowing us to participate in this series. We're deeply appreciative. With respect to charming my way into the presentation, as my mother always says, it might take charm to get you in the front door, but charm's not going to keep you there. So we'll definitely try to provide some thought-provoking facts. A few words about us and our firm for those of you who may not know us. We're Spiegel Accountancy Corp, and my name is Henry Chavez. I am the audit partner here in our firm. Our practice has been in existence for about 30 years, and we specialize in two industries, primarily in the financial services sector. One is private equity lending, and the other is mortgage banking, where we in fact started. We probably have anywhere from 40 to 50 total clients between audit and tax that we work on in the mortgage banking space. We have a national practice. In fact, most of our clients are outside of the San Francisco Bay Area where we reside, and they're in fact out of California. So we truly have a practice that's coast to coast. Enough about us. This presentation is an interesting one. When I started thinking about what I would present for purposes of Loan Vision, I started trying to think of something that was unique that I haven't presented before, and also something that I had never heard about before, at least during my career in public accounting, in a presentation or a conference. And it just so happened that concurrently I was working on financial statements for a client, and I said, wow. I said, I wonder how many of our clients really knows what goes into financial statement reporting in terms of what are our responsibilities and the auditors, or excuse me, management's responsibilities. And I started thinking about certain things with respect to that. In the private filing space, which most of the mortgage bankers are in, we don't have many publicly held clients, so we're talking about privately held clients. 98% of our clients have us draft the financial statements. That is an ominous number. So a lot of reliance is being placed on us to take on that function, which we're of course happy to do. When you think about that though, as management and what is our charge versus what is your charge, and making sure that these financial statements are produced in a way that's accurate, transparent, and also ensure that we're independent, maybe you're not aware of all that goes into that. So my intent was to really explain what is our role, your role, and all of the behind the scenes thinking that really happens on our part to ensure that we are drafting the financial statements correctly, yet letting management remain in control of that process. Okay, our responsibilities. I wanted to talk first about just what we as auditors are trying to accomplish. Our objective at the end of the day is to be the trusted advisor for the client. That's from the time I started in public accounting, which I won't date myself, but it's been a long time now. I've always heard that, and that's what we're working to do. So we can do that in a number of ways. And I've listed some of the services that we perform here, and whether that's tax advice and planning, all of the audit services, which for mortgage bankers is primarily audits, and the agreed upon procedures report for the LEAP filing process. We do a number of different consulting services, including financial planning, working on business combinations and the like. There's many services that we can do in consulting. Internal audit services we can also do, as well as bookkeeping services. Included in bookkeeping services is the financial statement preparation that we do for many of our clients. So in the spectrum of services, and when you're actually looking through the guidance, financial statement preparation falls under bookkeeping services. All of these services done individually present no problem in terms of our relationship with the client and ensuring that we are maintaining our objectivity. But have you ever thought about at what point does a CPA cross the line where we're performing so many different services for the client, you as the client, that we start to lose our objectivity? And that's one thing that I wanted to talk about, because there is a line, and if we cross it, we as the auditors and actually as the client, we're going to both run into problems. Okay, so how do we define what is that point where we run into issues where our independence could be impaired? At least from a privately held client perspective, the body that governs us is the AICPA. And their role, as I've listed here, they have various functions that they perform for us, but the one that we're most interested in, at least for purposes of what we're talking about today, has to deal with monitoring and enforcing compliance with technical standards, ethical standards, and independence standards. I'm going to show you what the AICPA deems to be independence and what we have to live by here. I give you a moment to just look at that and absorb that. At the end of the day, what the AICPA wants to ensure that we aren't either providing so many services or doing certain things that our judgment and objectivity can be impaired. And when it says here, without being affected by influences that comprise our professional judgment, there's definitely different things that can work against us to impair our judgment. And I'm going to talk about those shortly, but this is the criteria that they look at. And when it comes, and you might be asking, okay, I can understand how this might impact the auditor, but how does this impact me as the client? Why, in other words, why is this important to me? All right, well, as the CPA firm, if we lose our independence while working with you as a client, the implication to us is that we're going to have penalties and sanctions levied against us. The potential impact to the client is that if we lose our independence and we've reported on your financial statements, those financial statements are no longer valid and need to be re-audited. And management's going to have to go through the lost time and frustration of having to try to find another CPA firm to re-audit that work and reopine on it, and potentially also lost expense in having to pay from that. And while most times the CPA firm who lost their objectivity or lack of independence would have to pay, you never know what can happen. So there's clearly the lost time and frustration, particularly the expense that would come along with us losing our independence and you having to take other measures to reissue those financial statements again. That's why I think that this has a certain level of importance here in having us all understand what both we have to do and what you have to do to try to ensure that that line does not get crossed with respect to financial statement reporting. For us, when we look at that AICPA guidance, there's two ways that our independence can be impaired. And the terms that get used there are independence in fact and independence in appearance. And I'll talk about both of those in more detail. The standard independence in fact, that one's a little more black and white. It's basically it either happened or it didn't. It's not so much subject to interpretation, but the independence in appearance is a lot more difficult and subjective and where we potentially run into problems as auditors. So let me talk here a little bit about independence in fact. Here's the different criteria that are laid out for us to ensure that we are not tripping up an independence in fact issue when we're working with you as the client drafting financial statements and the like. The first one's pretty obvious, can't function in the role of management, means that we're not making any management level decisions when it comes to either your accounting policies or disclosures that are actually being made in those financial statements. We can actually draft them, but it's management's role to determine whether or not they agree and believe that that is the correct disclosure. Obviously, we don't want to be in a position where we're auditing our own work. That one is pretty much self-explanatory. But if, for example, there's no analysis of a certain area, let's just say secondary market reserve, for example, and we actually do it and audit it, sometimes that could be construed as us auditing our own work. And that's why a lot of times we're trying to ensure that the client is providing us at least with an opening analysis that deals with supporting many of their account balances. Serving in the role, an advocacy role for the client, I think that one's self-explanatory. And the last one there is having a mutual or conflicting role with the client. That one's a little bit more obscure, but a mutual interest, for example, would be if a partner in a firm had an interest in an equity type investment that the client also just so happens to have an investment in that equity investment, that would be a mutual interest in something that could impact our objectivity in auditing the financial statements. A conflicting role is a lot easier. For example, if my mother were the account manager at a client that I was auditing, that would be a conflict of interest. So those are some of the things that are independence and fact issues that are pretty easy to lay out there and understand before you get to the process of drafting financial statements or working on the audit for that matter. Independence in appearance is a lot more difficult because, in my opinion anyway, it's infinitely more subjective and it's someone's interpretation of facts and circumstances that are going to drive whether they determine that there's an independence impairment. But basically the definition or criteria that we look at is the one that you see there, where if someone has some sort of an independence problem with the CPA firm, if after looking at all the facts and circumstances, a reasonable person is going to determine that somehow our integrity, objectivity, or professional skepticism was impaired. Let me give you a few examples of that. Okay. I listed 3 different types of examples, everyone, although there are clearly more that exist. Advocacy risk, that one, the example there is pretty good, that if the company is working to sell itself and we're serving as an advocate to prospective buyers, we could run into a problem if we're also doing the audit, because the interest could be construed as self-serving. Intimidation risk, as an example here, a company's not happy with your proposed adjustments and they talk about if things keep going that way that they might switch auditors next year. And I've actually heard comments like this before, and that becomes pretty difficult for us to, I'll say, get through an audit when someone is making a statement like that, that they might switch it because they don't like the proposed adjustments. The third one is one that clearly can happen a lot. It's an interesting one, but I put an example here. If the audit partner is, for example, regularly playing golf with the CEO or CFO of the company. There was an actual case that I was reading about where the SEC actually brought suit against E&Y. It was back in 2016, because in that situation, the partner at E&Y was not only taking the CFO to regular sporting events, but they were also going on vacations between the families. And the partner had also spent $100,000 over a 3-year period in entertainment expenses with this particular CFO. In that situation, the SEC stated that the independence was impaired for the 3 years that were under audit, because this was an SEC filer actually, and the company basically had to go out and find another firm to have their financial statements re-audited. I've rarely seen that with privately held clients, but I can tell you that that type of situation does exist, and it can clearly happen. So it's something that we have to be cognizant of when we're thinking about our independence. So circling this back around to how it can impact us when we're doing our financial statement drafting. I think I've already talked about everything on this slide, but the most important thing that I'll talk about later is developing the safeguards around the process for both us as the auditors as well as management. Management's responsibilities. We as the auditors, ultimately what we are responsible for are the audit opinion. But everything that comes after that audit opinion in terms of the financial statements and footnotes belong to the client. So really, even though we're drafting these financial statements, it's management's charge to ensure that they they understand how the numbers are grouped together, how the policies are documented, and if they are an accurate reflection of what their company is doing and how they account for their different transactions. In terms of thinking through what are the safeguards that both we and management want to ensure that we are complying with, so that we've got accurately reported financial statements that aren't tripping any type of independence triggers, is management wants to assure that they've looked at and taken responsibility for all the financial reporting. Equally important is that from a financial statement reporting perspective, that senior management has assigned someone that has the skill level, knowledge, and expertise to be able to look at those financial statements and ensure that things are properly captured there. Now, this doesn't mean that that person is a CPA or even that they have an accounting degree per se. It just means that they've got enough acumen that they understand the different accounting pronouncements, how they roll into the financial statements, and how the reporting of the different of management's different policies and the transactions are following those guidelines. And also that the financial statement reporting in its totality is meeting the criteria as defined by the FASB. All of this that you see here in these requirements, when you're actually going through your engagement letter, it should be normally that something of this nature is defined in the engagement letter that would specify what management's responsibilities are. So here's what I've laid out in terms of management's responsibilities and our responsibilities. And the next thing is, how are we helping each other to ensure that we've got a good product and that management accomplishes their objectives in terms of financial statement reporting. We're able to help the client to get these financial statements drafted, yet not trigger any of our independent standards that we have to live with. And I think the most important thing that we have to do, a few of them, is one is when we're going through the financial statement disclosure with the clients, I think discussing what are the alternatives is a good process. Management asking us then, okay, here's a different standard. What are our different choices in us drafting these footnotes and us explaining the alternatives? Isn't us taking a management position per se. It's simply explaining what are the different alternatives and how they get interpreted in financial statement reporting and letting you make the decision. I think the other thing that is important here that I've listed is that reading through the financial statements, disclosures, and content before the financial statements are actually issued. I'll tell you, I have seen situations where I've got the management representation letter in hand, management's ready to issue, they do issue the financial statements, and I'll get a call a week later saying, we no longer like this disclosure, can you change it and reissue? That definitely can become complicated, particularly for the clients that are filing through LEAP. For example, I've seen this problem more with our private equity clients rather than mortgage banking, but I have seen it happen. So ensuring that the final decision maker is going through the financial statements, reviewing them, and if there's any change in content, to discuss that with the auditors so that we can make the required changes. Another important thing, although I didn't make it the subject of this presentation, is ensuring that when we're going between you as the client and we as the auditor are going through unadjusted proposed journal entries, that we're really talking through the significance of them to ensure that the end product that we wind up with is correctly stated, or at least to a point where if we don't post an adjustment, it's not impacting the opinion of the reader of those financial statements, right? And that can become particularly important if a client is close to breaking some sort of financial statement covenant, and the difference between recording an entry and not recording it would trip the trigger of a covenant violation. That's when you really have to think through those types of proposed journal entries and talk it over with the auditor. Next thing that's really important is when management has new transactions that they are dealing with, to ensure that as they're going through the process, they are actually talking with the auditor to ensure that the way that they think the transaction is going to be reported on their financial statements is actually what's going to happen. And there's definitely various times where I see clients that are either getting into a business combination or something, a different type of transaction with respect to buying participations in loans, where they think it's going to look one way on their financial statements. But after we read the literature and determine how the accounting literature gets applied, it's not going to wind out that way. And definitely, while the accounting doesn't by any stretch of the imagination drive the operations and decisions made, it's about knowledge being power and understanding how any transaction, significant transaction that you take on will, what impact it'll have on your financial statement reporting. And I'd say the last thing here has to do with new accounting pronouncements and ensuring that you're talking with your auditor about them before they occur, because sometimes they can have a major impact. One, for example, is the lease accounting, which, while it was delayed this year and won't be effective till the end of next year for 2022, it can have, depending on the operation of the client, it can be a major undertaking. And talking about how that's going to get transacted, how it will get reflected in your books and records and actually on your financials can be significant. And you want to ensure that you've talked that through with the auditor to make sure that it goes well. And I think if all of these different steps get performed, it definitely helps in terms of ensuring that we've got a good set of financial statements that are transparent and clear, that management has an understanding of some of the disclosures that are in there that are sometimes obscure, and that we haven't triggered our reporting. And you know, everyone, when I look at some of our financial statements, which sometimes are 50 pages long, there is a lot of language in there that sometimes seems like boilerplate. And we want to just all ensure that we have an understanding of what it is and the reason why it's in there. Because if anyone ever asks you about it, both you and we want to ensure that we're able to address the questions. And I think particularly management, because at the end, it's the financial statements belong to management. And that is the presentation with respect to demystifying the financial statements. As I said, the goal was to provide a little more clarity as to what our responsibilities are and what are yours, and how we can work together to ensure that we've got a great product. Jordan, that's what I have.
Henry, thank you. Thank you for presenting today. It's definitely interesting to see how those lines can get blurred so easily between who is responsible for what. I want to thank you for sharing your knowledge today, and everyone, thank you for tuning in today, and thank you for also tuning in for the entire series. Like I said before, this is the end of the industry insights, but you will all get the recording from today's session. If you have any questions, feel free to send them to us in the Q&A box now, or you can also send them to us via email, and I can forward them on to Henry.
Thank you, Jordan, and thank you to everyone who tuned in. And if you have any questions, obviously feel free to contact us. Have a great day.
Have a great day, everyone.